Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. Hi, I'm Greg Milano, founder and CEO of Fortuna Advisors and the host of the Create More Value podcast. Normally, I have guests with me on my podcast, but today I'm going to be presenting by myself a very important, sort of message about how to evaluate businesses that have different business models. And this is primarily aimed at corporate people in business and companies that have different businesses that have different business models, but it can also be useful for investors that are trying to evaluate businesses that have different business models, to make sure they understand things. I will be using slides during this, so you might find that it would be better to watch this on YouTube. But if you want to pay attention, watch this on, listen to it on a Apple Podcast or another platform. You probably won't get everything out of it because you don't see the slides, but I'm sure that would be fine. So, evaluating different business models, episode 44 of Create More Value podcast. Now, we're going to talk specifically about strategic resource allocation, which is sort of like capital allocation, but it includes other resources like innovation spending and marketing spending. And we recently, in episode 43, produced, we actually started with a LinkedIn Live event, and then we took the video of that and made it into podcast episode 43. It was me and my partner, Marwan Karame, talking generally about strategic resource allocation. I encourage you to watch that. There's a lot of useful information in there about what this is all about. But I'm just going to draw upon one slide from that episode in order to just make the point here for those who did not get to see that episode. And this is based on a client case study. It's a real world client, but we, of course, disguise the numbers to protect their confidentiality. They had a lot of businesses, and this was a view of their plans. The x-axis shows how much value is created in the plan per dollar invested during the plan. And on the vertical axis, we have what we call the reinvestment rate, which, if you're not familiar with it, is the amount of investment in the business as a percentage of the amount of cash that business produces. So what we'd like to see, of course, is a higher reinvestment rate in the businesses on the right that are creating more value and a lower reinvestment rate on the left. But I have to tell you that more than half the time, this is what the graph looks like when we meet a new company. Higher reinvestment rates in the businesses that are destroying value or at least creating less value than we see in the businesses that have the potential to create a lot of value. This is like Warren Buffett buying the stocks he thinks are going to go down rather than the ones he thinks are going to go up. So in this particular client case, we then did a top-down reallocation of resources working with corporate finance and corporate strategy. And then we used that at a big leadership offsite meeting to stimulate a new bottom-up plan, which led to a lot better allocation of resources. The top-down plan, just for reference, looked like this after we got done working with corporate finance and corporate strategy. And for every dollar we moved, the NPV of the consolidated forecast went up by $3. So stopping investing in weaker businesses and reallocating those resources to stronger businesses has a lot of bang for the buck because you're eliminating a negative and adding a positive, kind of all at the same time. And so this was a great case. And I encourage you to go back to episode 43 if you want to learn more about this case. I'm not going to repeat it all here, but we provided more information and context in that episode. Now, in principle, strategic resource allocation seems very simple. When we tell people you should invest more in your good businesses, they look at us like we have four heads. But in reality, it's very hard. And it's getting harder. And one of the main reasons for that is that modern business models have a lot of investment going on the P&L, which distorts all the traditional accounting and other financial measures that people use. And they get a very bad picture of where they should be investing resources. They think they're seeing reality, but they're really not. Many standalone companies that employ a modern business model actually do extremely well in the stock market. But when these businesses are captive inside of a bigger company, they very often are misunderstood and the value creation is underappreciated. and that has big disastrous effects on skewing the resource allocation away from the good businesses and toward the more traditional businesses that do look good on all the traditional metrics. So, in order to be able to kind of illustrate this well, we came up in preparing for meeting with a client recently. We came up with this sort of case study, and it's not really a case study. That's why the quotes are there. It's a hypothetical or made up case study in order to really prove the point with businesses everybody knows. And the hypothetical company has two business units back in 2012, and those business units are called Walmart and Amazon. And all the analysis is based on the actual performance of Walmart and Amazon. And we're going to look at some of what was going on in the earnings reports of these companies. We're going to couch it as if these were like operating reviews inside the business. And then we're going to look at a traditional financial analysis of these companies. And I think, you're going to see that many corporate centers would have concluded that they should pour all their money into Walmart because it was so much more profitable at that point in time. And then finally, we're going to apply our residual cash earnings, or RCE, framework to show how RCE clarifies the decisions faced by management and how they're just frankly more correct than the signals you get from all the other measures. So let's go get to it. So highlights from the hypothetical operating reviews. Again, these are things we pulled out of the first earnings report of the transcripts from the calendar year 2013. So about the prior fiscal year. In Walmart's case, they talked about a 10.6% growth in EPS and 18% dividend growth, 3 consecutive years of reducing operating expenses, as a percent of sales. You can see the finance people in the corporate, if this were a business unit, saying, "Oh, this is great. You guys are really nailing it. Great. Look at your free cash flow. It's over $12 billion now. That's awesome." They had a commitment to providing 100,000 jobs to recent honorably discharged U.S. military personnel, which has two sort of sides to it. One is this is obviously a very noble thing to do. These are people that enlisted to be able to protect us, and oftentimes they struggle to find jobs when they first get out of the military. So this was a very good thing for those people. And I think for Walmart, it served the second purpose. They were being criticized for how they treat their workforce and so forth at that time, and doing something that had perceived by most as a very noble thing, was probably beneficial in terms of counteracting some of that sort of public image, which is good. They were piloting Scan and Go. This is technology. It's great stuff. People could use their mobile phone to scan things as they shopped in the store, and you can still do this today, I believe. It made the customer experience better, made the checkout faster, and so forth. They opened 129 supercenters in the U.S. and a lot of other smaller stores as well. They increased the international footprint by 19 million, square feet over the period. They hit 4,000 stores, which was pretty cool during the period. I mean, a lot of these are such big stores; it's hard to imagine there's 4,000 of them out there. And they were excited about their investments in e-commerce. They spent quite a bit of time talking about new search engines for people to be able to find products and so forth. And so, before we even get to Amazon, you could see the corporate people saying, Walmart's doing a great job in e-commerce. Why do we even need Amazon? And then they looked, then the operating review with Amazon would have started out with, worldwide revenue growth was, not the sort of 5% you saw in Walmart, but 27%. And Amazon operating cash flow increased 7% to the 4.18. Corporate people would have been saying, why did operating cash flow only increase 7% if revenue increased 27%? What's the give? Capital expenditures climbed to almost $4 billion, which you notice is pretty close to the operating cash flow. And when you then considered also changes in working capital, that had a really big impact. They opened 20 new fulfillment centers so they'd be closer to their customers, be able to provide faster delivery. A lot of things didn't have to get on a plane anymore. They were in fulfillment centers that are actually pretty close to a very large percentage of their customers, so they could provide fast delivery and manage cost as well. These are massive fulfillment centers, so these are huge investments. Their free cash flow dropped 81%. Again, you can see the corporate people saying Walmart grew their cash flow. Amazon knocked their free cash flow down by 80%. Something's really wrong here. If you follow our work, like our value leadership reports that we publish every year, you'll find that as a period measure, free cash flow actually has a really terrible relationship to total shareholder return. People talk about it a lot. And of course, it's really important in terms of being the driver of the net present value model of free cash flow over time. But free cash flow in a particular year is actually really, pretty unmeaningful. But in a lot of companies, it's very important. So this would have been a really telltale sign that, Amazon just can't get out of their own way, like their free cash flow dropped by 80%. Kindles were driving growth. Their ebook business was growing at 70% year over year, which is, really stunning. And they had a lot of growth in other areas too. Prime membership was growing. Third party sales, other people selling product through their website was going really well. Total SKUs available was climbing rapidly. Prime video streaming was growing. And this is interesting because they don't charge separately for that. You just get that through Prime membership. Very different mindset in terms of trying to provide an experience for the customer at Amazon. Not everything has to earn its own profit. If that gets more people to buy Prime memberships, I mean, I can tell you actually from the experience that my wife and I had that we became Prime members originally because we, much after the series was done, started watching the show 24. And I forget what we were watching it on, but all of a sudden they no longer had the rights to it and it was available on Prime. And we bought a Prime membership originally, had nothing to do with buying anything on Amazon because we wanted to watch the show 24 with Kiefer Sutherland. So it was, very interesting how that, drove, my experience very specifically. So, if you look at all this, what would the corporate staff have been thinking at the end of these operating reviews? They would have been kind of shaking their head about Amazon. They don't really, look like they're really, following the plan of what we have. And Walmart just keeps delivering, and 4,000 stores and all the free cash flow, $12.7 billion, and everything, looked really great for them. They would have also done some financial analysis. So let's take a look at what they might have looked at. So, if you start out with growth, if you look at the 5-year CAGR, Amazon had way higher growth than Walmart, and of course, if you look at even the most recent year, Amazon was still over 5 times the revenue growth of Walmart. And this is a real feather in Amazon's cap. But as you'll see on the next few pages, in terms of margins and returns, Amazon didn't look as good. So a lot of corporate people might have been saying, "Oh, that Amazon division, they're just growing for growth's sake. They're not really producing, any value. Walmart's not growing as fast, but at least it's not this good, profitable, high free cash flow generating, growth." By the way, the free cash flow story is interesting with Walmart because there was a period back in the 80s and 90s. I think it was a 16-year period where Walmart had negative free cash flow in 15 of those 16 years. I talk about it in my book. And over that period, their TSR was like over 4,000% or something. I mean, it was really a stunning, refuting of the validity of free cash flow on a period basis. But to this day, a lot of people use it as a period measure. And so Walmart would have been praised on that. And this growth rate, although significant, might have been dismissed, for Amazon. If we then look at scale, it's not like night and day here, right? Walmart was 88% of the revenue and 94% of the EBITDA. And what often happens, what I hear a lot of times inside companies is, people saying things like, well, Amazon, even if they figure out how to improve margins, they're so small, it's not going to have a real meaningful impact. It's not going to move the needle, as they say, on corporate. Just a few, percent improvement in Walmart would have a massive impact on corporate. So the focus goes on the thing with the scale, the thing that's going to move the needle. And there'll be a lot of talking about, oh yeah, Amazon's the way of the future and everything else, but they want to control how much they try to grow it because it's diluting their returns and everything else. So when we look beyond this, if you just did a quick analysis of, if they kept growing at the rates they grew in the most recent year, it would have taken 11 years for Amazon to pass Walmart in terms of revenue. And in the real world, 2024 was the 12th year, so they should have been passed by then. Amazon still hasn't caught Walmart on revenue. So even though the growth rate is higher, the scale is still tipped in the favor of Walmart in terms of total revenue. If we looked at EBITDA margin back then, Walmart had a much higher, sort of EBITDA margin, and that would have been pointed to that even though the growth rate is higher, the EBITDA margin is much lower for Amazon. But if we look at return on invested capital, which is based on EBIT, not EBITDA, in this case, it's a pre-tax return on invested capital, EBIT divided by the total of the net debt and equity capital average for the period, was a nice positive 22.4% for Walmart and almost negative 9% for Amazon. This would have been the most telling stat. A lot of times people say, well, just look at the return on capital. And in this case, it would have been, you're growing at 27%, you get a negative 9% return on capital. This is just a disaster waiting to happen. And that's what a lot of people were saying about Amazon at the time. They thought it was a charade. They were faking out Wall Street and so forth, because of all this. So despite Amazon's stronger growth, the sheer scale of Walmart, coupled with superior margins and returns, would likely have led corporate to emphasize growing Walmart, trying to find any way to build more stores and do whatever you can to grow Walmart, and would have gone along with the story at Amazon, probably because it was a nice thing to talk about in the earnings calls, but they wouldn't have wanted to put too much money into it because it would just dilute the returns of the total pie. Now, if they had just taken one step further in their analysis, they might have started to see what we see when we apply our approach. And that one step is to say, well, R&D is really an investment, but accounting calls for it to be expensed in the period that it's spent. And I know there's a big debate about how much of what people call R&D at Amazon is really R&D versus operating expense. But in our models, we just treat it all as if it was an investment, and we get some phenomenal results in terms of tracking that share price. But again, I'll get to that in a minute. If you take a look at what treating R&D as an investment would have looked like just from a margin perspective, and you took EBITDA margin and you added back the R&D to get to an EBITDA margin, you would have seen Amazon actually had a higher margin than Walmart. So if R&D were capitalized like CapEx is capitalized, Amazon would have actually had a higher margin, and that would have been really interesting, I think, if had people looked at that. But very few corporates look at it this way. So this is really just kind of an academic exercise. But this is, if even for people that don't want to implement our whole framework, if you've got one business that has a lot of R&D and the other one that doesn't, please use EBITDA. You're going to get a better picture of the period profitability of the business. So next, we're going to apply our residual cash earnings, which is a cash-based modern economic profit measure, to show how it clarifies the decisions faced by management. And it really is pretty amazing what a good job it does with these two businesses. So first, what is it? Residual cash earnings is, it's a form of economic profit where we don't charge depreciation and we treat R&D as an investment. So on the left side of this little graphic here, we have what we call gross cash earnings, which is EBITDA after tax, add back the rent, add back the R&D. Now, these days, we don't always add back the rent. The changes in accounting policy have made it often, unimportant. But we still see some companies where there are some adjustments that need to be made there. But the big one here is adding back the R&D. That's a huge number for Amazon. And then on the right, we have a capital charge, which is like capital times the cost of capital. But capital has two big changes to it, especially for Amazon. First is we add back the accumulated depreciation. We're not charging for depreciation, so we don't depreciate the assets. That's just for consistency. And then also included in the gross operating assets would be the capitalized R&D. We take the last 5 years of spending and just add it on a gross basis, undepreciated, unamortized, to the capital base. And so a lot more capital, of course, in our model than what you would see in a traditional model when you look at Amazon. And what's left over is sort of RCE. And in RCE relates better to TSR than traditional financial measures. Every year we publish a value leadership report. These days, I think it's published in January. And every year we recreate the research, and every year the changes in RCE relate better to TSR than any other traditional financial measure. It even relates better to TSR than EVA. And in this article called Beyond EVA, we showed all the research on that, which showed that in every industry, RCE relates to TSR better than EVA. And then importantly, companies that incentivize on an economic profit measure, whether it's ours or EVA or another form of economic profit, on average outperform on total shareholder return. They outperform the market by an average of 7% a year, and they outperform their peer companies by almost 5% a year. So this has been proven to work. There's fact-based evidence showing that companies that do this do better than their peers and better than the market. And so there's real evidence suggesting companies should consider this beyond what I'm going to show you in the coming pages when we apply residual cash earnings to both Amazon and Walmart. You can email us if you'd like to see the research backing up these statements. We'll send you the original research. So if we look now at residual cash earnings as a margin, we see that Amazon's got 3.5 times the RCE margin that Walmart has. So although EBITDA looks so much better for Walmart, when we make these adjustments to treat R&D as an investment and to not depreciate assets, again, things that cause our measure to track TSR better, track what the market actually does when they value companies better, we now have 3.5 times. So now we've got 3.5 times the margin growing at 5 times the growth rate. Maybe it starts to get pretty obvious why Amazon's share price has done so well. But if you now go back to the hypothetical case study, if you're a corporate and you're using this framework, you're getting a completely different picture of where you should be investing. And of course, we all know what's happened, so we know that it's a better picture. It's a more accurate picture. We all know that the right bet at the time would have been to invest in Amazon more heavily, not Walmart. And then when we look at the changes in RCE, which is what really relates to TSR, it's not the absolute level of RCE that matters, it's the change in RCE. And what we often do is we take the 5-year change in the dollars of RCE and divide it by the beginning gross operating assets at the beginning of the 5-year period, as of the end of 2012, phenomenally, that growth was 260% for the dollars of change in RCE divided by the beginning gross operating assets was 260% for Amazon, and it was only 2% for Walmart. So these metrics show a completely different picture, and they validly show that Amazon was really creating a lot more value at the time. And we can confirm that in a minute when we look at the total shareholder return. Now, a lot of people look at return on invested capital, and here we're doing an after-tax version of that. It's net operating profit after taxes divided by invested capital. We have a similar measure in our framework. We call it gross business return. We use the same gross cash earnings we use to calculate RCE, and we divide it by average gross operating assets, the same gross operating assets we use for RCE. And this way you'll get a chance to see, well, is there a return-based measure that's actually better than return on invested capital that, especially for these modern business models? And you can see that Amazon had more than 3 times the gross business return. So growing 5 times as fast, over 3 times the gross business return. I mean, it was just a money machine, which of course is what's reflected in their share price. When we look at total shareholder return over the period, Amazon had almost 3 times the total shareholder return over the period, which is really, quite a stunning story. It told the right story, right? RCE growth showed Amazon was creating more value, and the stock market also showed Amazon was creating more value. So, companies with a mix of established capital-intensive operations and digitally driven businesses, which is many companies these days, should embrace RCE as their measure of choice, as it does a better job of explaining value creation and informing strategic resource allocation. It puts these 2 different business models on a much more relatable footing, where value is really recognized much more accurately. So what happened after 2012? I mean, we all know the story, but I'll show you some facts in terms of, would it have been the right bet to be plowing more money into Amazon, which of course is what happened in the real world, than what was poured into Walmart. When we look at residual cash earnings, what we find is that Amazon only had about half the residual cash earnings of Walmart back in 2012. But Walmart only went from 13 to 21 over the next 12 years, while Amazon went from $6 to $157 billion of residual cash earnings. And with Amazon, over most of these years, if we simply capitalize the RCE by dividing by the required return on capital, add the gross operating assets, subtract the net debt, divide by the number of shares, for most of these years until recently, you get a share price that actually relates to Amazon's share price pretty well. In recent years, there's been a disconnect. They're trading at a meaningful discount. So the market seems to be pricing in that they expect RCE to decline, although it keeps going up. So in the last 2 years, it looks like they're a buy, but of course, this is not investment advice. Walmart only went from 13 to 21 million. They really didn't create anywhere near as much value. So what happened in the stock market? Well, if we look at cumulative total shareholder return over this period, Walmart just delivered the same return as the market. They were just like investing in the field. They didn't create any additional value versus just buying a diverse portfolio like the S&P 500. And this is based, by the way, on the SPY ETF that tracks the S&P 500, including dividends, just like we do for Walmart and Amazon. And of course, Amazon produced over 4 times that TSR, which is really pretty stunning, over the period. So the reality is that going back to 2012, if this were a company with 2 businesses called Walmart and Amazon, the priority should have been investing in Amazon, which would not have been the case if you were using traditional metrics to determine, where to allocate resources. So if you're in a business that has different business models and you're interested in learning more about whether or not this can apply to you, contact us at info@fortuna-advisors.com, and we'd be happy to have a conversation, even run some analysis for you to let you see, whether or not this would be helpful. Thank you very much for listening. I really appreciate it. And happy to answer any questions anybody has. You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.